were told the stock market is a machine that rewards patience, discipline, and smart research. And then you watched your neighbor get evicted while the index hit another high. You were told housing was an investment you could trust. And then you watched your paycheck get swallowed by rent, groceries, and insurance, while the rich treated those bills like background noise. Here is the uncomfortable truth nobody markets on YouTube in 2026. The rules of the market do not come from computers, charts, or liquid alternatives. They come from you. From your fear when prices fall, from your greed when prices rise, from the exact moment you decide you are special enough to break the pattern. This is not financial advice, this is financial education, and by the end of this you will understand why most people lose money in markets even when they are right on direction, even when they do everything they were taught, even when they start with good intentions. Let me start with a story you probably won't like, because it's too accurate to ignore.
Imagine a ship captain from the old world, the kind of man who has stood on a deck during storms and learned to read chaos like it's weather. He tells his son a simple lesson on his 23rd birthday, not in a spreadsheet, not in a philosophy book, but in the oldest classroom on earth, a gambling table. He gives his son $2,000 and tells him to practice counting moves before he ever counts profits. Then he adds one rule that sounds almost insulting in its simplicity. Keep $500 safe no matter what. Don't turn a lesson into a disaster. Don't treat the table like a god. His son nods. He even promises. Then the table starts talking. Not with words, with sensations, the rhythm of bets, the twitch of hope when the next hand might finally be the one. He loses track of time the way adults lose track of budgets on payday. The rule about keeping the 500 slips out of his mind like a password forgotten. He chases. He believes the last two losses were just bad luck, not a warning. Then he runs out of money, and here is where the lesson becomes brutal. He doesn't accept the loss as a cost of learning. He treats it like a temporary glitch. He says, in effect, that the next two plays must reverse it. He thinks he can win it back by force. So he goes back again. The father tells him, this time you don't get a second gift. You have to earn your way back. 6 months of work, a real paycheck, $700, and then back to the table. His son now tries to simulate discipline. He creates a rule, lose only half. If half is gone, you leave, easy. But the table doesn't care about your rules. The table cares about your psychology. He loses, reaches the halfway point, and freezes like someone standing on train tracks while the train is already visible. He cannot leave. Not because he is unaware, but because he is emotionally trapped by what he believes leaving would mean. Leaving feels like admitting defeat. Staying feels like reclaiming identity. So he breaks his own rule, bets everything, and loses it all again. Do you see what happened? This wasn't a lack of knowledge. He wasn't dumb. He wasn't illiterate. He had a plan. Then emotion arrived, and the plan became a decoration. The third time, he finally gets something right, not because he suddenly understands the math better, but because he understands himself better. He waits. He keeps calm. When he loses half, he actually leaves. Even when he loses, he feels like he won, because he controlled the part that usually controls you. That's the first law, not the market law, the human law. Now the father realizes something else. The reason the market looks like it has rules is not because the chart is holy. It's because human behavior repeats under pressure. That is why patterns show up again and again. Not because the future is predictable, but because fear and greed are predictable. And then, in a twist that sounds almost silly until you think about 2026, the father brings his son back later and hands him financial control over a massive company. Not because the son learned how to read every chart, but because he learned when to leave while winning and when to leave while losing. He gave him the one skill that beats the majority in any arena where money is involved: the ability to stop. That idea sounds poetic. It is not. It is a survival skill, and it connects directly to what you are experiencing right now in 2026. You are living through an environment where the market can hit records while the average person's purchasing power bleeds out. Inflation may show calmer numbers on paper, but the lived reality is different. The price of energy, food, rent, childcare, and insurance does not care about your spreadsheet. Meanwhile, the Federal Reserve can cut or hold rates, and you still feel the lag damage in your mortgage, your credit card interest, your cost of everything. So your life becomes a tug of war between official data and real cost. In that tug of war, people reach for the same anesthetic as the gambler. They chase certainty. They chase a trade that will finally fix it. They chase passive income scams. They chase a fantasy that the next move will save them. But the market doesn't reward fantasies. It rewards constraints. Let's move from the table to the Wall Street floor, from dice to liquidity, from a father's rule to the hidden rules that control your behavior in modern financial systems. The second law is this: the market doesn't fight your intelligence, it uses your instincts. In 2026, the instincts are worse because you are fed them non-stop. Your phone is a slot machine that pays out attention. Your feed shows winners and hides losers. It sells you the idea that everybody is getting rich quietly, steadily, effortlessly. That is how you get trapped. Not by a single bad decision, by a continuous stream of emotional triggers. When you start, you think you are making decisions. But most of your decisions are actually reactions to information designed to move you. The same human reflex that made the son unable to leave the table at the halfway point makes you unable to sell when you are down, unable to stop buying when price jumps, unable to admit you were wrong. You don't want to feel regret. Regret feels like death. The market knows that, and it exploits it through time pressure and social pressure. When rates change, when the Fed hints, when inflation prints, when the yield curve behaves oddly, when insurance markets collapse in certain regions and people migrate, markets reprice quickly. You can be right on the bigger story and still lose money because you cannot control the timing inside your own nervous system. Picture a 40-year-old nurse in Arizona. Let's call him David. David is not a day trader. He isn't trying to beat the market. He is trying to survive. He has student debt and a mortgage that keeps getting stretched. He watches his retirement account wobble with headlines. Then he hears that inflation is coming down, so the Fed might ease, so stocks might surge. David does what most people do. He believes relief is around the corner. He sees a dip and thinks, this is the entry. He sees a rally and thinks, I missed it, I have to catch up. He checks his app 12 times in a week. He starts averaging down, not because it's rational, but because leaving feels like admitting he has less control than he wanted. Then one day his fund drops again, and he sells in panic at the low, locking in losses. Not because the thesis collapsed, because his emotions finally got tired. That's not a bad nurse, that's a human brain under stress. And here is where 2026 makes the trap sharper. AI didn't just change the market, it changed the speed of everything around the market. Trading algorithms move in fractions of a second. News propagation is instantaneous. Financial influencers can produce content at scale. You can get 1,000 explanations in a day, and none of them will save you from the instinct to act when your stomach hurts. The third law is, fear and greed are not moral failures. They are functional reactions. The problem is that nobody teaches you how to govern them. Extreme fear makes you act like a child. Extreme greed makes you act like a child. Both are emotional states, not logic. In the story, the son froze at the halfway loss threshold. That's fear. Later, when he finally succeeds, he stays too long because he cannot stop when the feeling is good. That's greed. The father's message is simple but unforgiving. You can leave when you are winning. Most people cannot. They think winning means they are entitled to keep winning. They forget a rule that every professional learns the hard way. Your permission to stop is more valuable than your permission to enter. Now, connect that to the real world in 2026. When markets rise, it feels like the pain is over. You start believing the index is the economy. You start believing the highest headline is the truth. You start imagining that wealth is spreading, but wealth concentration is accelerating. According to widely cited analyses using Federal Reserve data, the top 1% owns a larger share of wealth than most people can mentally picture. While you are trying to decide whether to renew your lease, the wealthiest are borrowing against assets at low interest. They are not selling enough of their stock to feel the volatility. They can wait out downturns because their system doesn't depend on month-to-month cash flow. You do. So when you see the market climb, you feel hope. When it falls, you feel doom. And your emotional extremes make you trade like the gambling sun. You enter and exit at the worst possible moments because your brain is not built for long-term cycles. It is built for immediate survival. That's understanding, but it can get darker. Because once you admit that the market is a reflection of human emotion, you also have to admit something else. The market is not obligated to validate your reasons. You may have studied company fundamentals. You may have looked at valuation metrics. You may have read reports. You may have listened to someone explain why a sector is undervalued. And then the market can still do something cruel in the short term. The stock can drop because liquidity dries up. It can spike because speculation runs ahead of earnings. It can stay irrational longer than you can stay calm. That is not a conspiracy. That is a mechanical outcome of thousands of participants reacting to uncertainty. In 2026, uncertainty is constant. Global debt levels exceed $300 trillion. That creates fragility. Debt doesn't disappear. It rolls, and rolling requires refinancing into higher or lower rate environments. When the Federal Reserve keeps policy tight or even just stays higher for longer, debt service costs hit slower industries first and faster consumers second. That means real-world pain before market optimism. So when you look at a chart during an emotional day, you are seeing the behavior of people who also have debt, incentives, and fragile nerves. The market doesn't need to be rigged in a Hollywood way. It just needs humans with leveraged positions and limited patience patience. And then comes the part nobody wants to say out loud. Most people do not lose money because markets are random. They lose money because their process is not designed to survive their emotions. That process failure is now being amplified by AI and by creator culture. AI can write code better than a lot of the entry-level workforce you were promised you could become.
It can automate tasks that used to be career ladders. The learn-to-code advice from the early 20s starts sounding like a joke as AI writes, tests, and deploys. Whole categories of middle-class employment compress. That pushes people into financial anxiety faster than their budgeting can adjust. And then social media hands them a second crisis. It sells financial identity. It sells the dream of passive income. It sells the illusion that you can buy freedom with one strategy, one course, one viral timeline. Meanwhile, most creators earn almost nothing from content. The creator economy is mostly a treadmill. You do not become rich by being consistent. You become rich when you have distribution power and audience capture, usually before the public understands the trap. Most people are not building wealth, they are building desperation with better lighting. So when markets move, you treat it like a referendum on your worth. David the nurse becomes not just a participant in retirement savings, but a character in a story he tells himself. I deserve this. I earned this. I can fix this with one more move. That mindset is identical to the gambler who stayed on the table because the feeling of almost winning was stronger than his rule. Now we have to address the stock market's laws as they actually show up in your life. The first law is that timing matters more than prediction. A lot of newcomers believe they are supposed to find the perfect insight. In reality, the market is not a quiz, it is an arena. You do not get points for being intellectually correct. You get points for executing under constraints. If you have ever bought a stock because you believed it was cheap, then watched it get cheaper, you already learned this. If you have ever sold because the price rose and then watched it continue rising, you already learned this. Your feelings about hindsight are not strategies. The ship captain in the story didn't teach his son a magic indicator. He taught him to impose an exit rule. In professional investing terms, that means stop losses, position sizing, and risk limits. In human terms, it means deciding what you will do before the emotions arrive. That is the hidden system behind so-called successful traders. They don't just have opinions. They have rules that keep them from turning one bad moment into a lifelong scar. Here is a pattern interrupt. Take a moment and ask yourself a painful question. If you knew you were about to feel fear in 6 hours, would you make a trade then? If you knew greed would arrive when the price moves in your favor, would you stay just a little longer? Of course not, but you don't know. You assume you will behave rationally when the moment comes. That assumption is how people burn accounts. In 2026, this is not theoretical. AI-driven market making, high-frequency execution, and leveraged ETFs can create fast moves that punish manual decision-making. If your plan relies on emotional discipline in the middle of chaos, you are writing fiction. The second law is that complexity is not a cure. People start with simple ideas. Then they add layers, indicators, frameworks, stories, macro narratives, randomly selected timeframes. They do it because the uncertainty is unbearable. A simple rule would say, define risk, wait for your signal, execute, exit. But uncertainty feels like danger, so your brain demands more explanation. It wants to buy comfort, not understanding. And here is where the market laughs. The market is efficient enough to move, but not consistent enough to validate your comfort. That's why you can see a chart, draw a pattern, and still get wrecked. Not because you are wrong about charts, but because your behavior becomes dependent on the pattern you want to be true. This is the paradox of modern trading content. Videos show the winners, they show the entries that worked. They never show the 10 times the same setup failed when the trader's emotions broke their rules. Complexity becomes a disguise for emotional avoidance. You watch a sophisticated model and think, if I just buy the right model, I will never feel fear again. That is not how humans work. No model can eliminate your nervous system, only constraints can. Now the third law is patience, but not passive patience. Patience is not doing nothing. Patience is refusing to act when conditions are wrong, even if you feel pressure to participate. In the story, the son leaving at a loss was not optimism, it was discipline. In 2026, the world is designed to make you participate. Your employer wants you to stay in constant productivity. Your bank wants you to swipe and carry balances. Your platform wants you to scroll. Your influencer wants you to buy now. So patience requires defending your attention like it is money, because in practice, it is. In markets, the best entry is often boring. It doesn't feel urgent. It doesn't go viral. It feels like you are missing out. That is why people don't take it. And that is why the people who survive do what feels wrong at the time. They wait. But they also prepare for the reality that the trade might not work, and their risk is capped.
The fourth law is uncomfortable. Doing the correct thing means you might still lose. This law is where most people break. They think correctness guarantees outcome. But in markets, correctness is only about your process and your sizing, not about the final price. If you buy a position with a margin of safety and your thesis deteriorates due to changing facts, you have to accept that you may still lose money even when you acted responsibly. That's not failure. Failure is ignoring reality and insisting the market owes you a receipt. That is the gambler who returns again and again without changing the emotional rule.
That is the investor who refuses to update when fundamentals shift. That is the person who sells only because it hurts, not because a plan says the edge is gone. In 2026, this is increasingly relevant to housing and to debt. People assume a fundamentals anchor, like wages growing or home prices rising. Then insurance markets collapse in certain regions due to climate-driven losses. Premiums rise or coverage disappears. That changes cash flow and ability to pay. Fundamentals can shift abruptly. Your emotional comfort with the past becomes a liability. Now you might ask, okay, but what does this mean in real investing terms, not parables? It means you need a margin of safety mindset, not a hope mindset. When valuation is stretched, your expected return often shrinks because you are paying too much for future optimism. Even if the company performs, your entry price can make the overall outcome disappointing. That's why people experience it's a great company and still lose money for years. The market can punish overpaying, regardless of narrative. In the same way, in 2026, people overpay for lifestyle risk. They overpay for rent. They overpay for debt.
They overpay for subscriptions and convenience. Then inflation eats them alive. And when they finally attempt to correct, the correction arrives with job uncertainty. This is not a moral story, it is a math and psychology story. The market is full of people trying to justify paying more than they should. They do it by telling themselves a story about the future. They call it investing. Sometimes it's investing. Often it's just delayed regret. And here is where the dark